Tax loss harvesting is one of the most underused strategies to legally reduce your investment tax bill. Today we break down exactly how to do it in 2026, including the critical wash sale rule you must avoid. Tax loss harvesting means selling an investment that has declined in value below what you paid for it. The loss is realized on your tax return and can offset capital gains from other investments. If your losses exceed your gains, up to $3,000 per year can be deducted against ordinary income. Any excess loss carries forward to future years indefinitely. All of this happens in your taxable brokerage account, not retirement accounts. Here's how the offsetting works. You sell a stock for a $15,000 gain. That gain is taxable at 15% long-term capital gains, a $2,250 tax bill. But you also have another investment sitting at a $15,000 loss. Sell that too, realize the loss, and it offsets your gain dollar for dollar. Net gain, 0. Tax owed, 0. You've sold a loser, kept your winner, and paid nothing in capital gains tax this year. The wash sale rule is the critical trap that invalidates the loss. If you sell a security at a loss and buy the same or a substantially identical security within 30 days before or after the sale, the IRS disallows the loss. You cannot sell a S&P 500 fund and immediately buy the same S&P 500 fund. However, you can sell a Vanguard S&P 500 fund and immediately buy a Fidelity S&P 500 fund. They track the same index but are not considered identical securities. Substantially identical is not defined with precision by the IRS, but some guidelines are clear. Two different index funds tracking the same index from different providers are generally considered safe to swap. But a fund and its own ETF share class may be considered identical. Individual stocks are identical to the same stock. ETFs and mutual funds tracking different but similar indexes, like the S&P 500 versus the total U.S. stock market, are generally considered different enough. Types of capital gains you can offset. Short-term gains, on assets held 1 year or less, are taxed as ordinary income at rates up to 37%. Long-term gains, on assets held more than 1 year, are taxed at 0%, 15%, or 20% in 2026 depending on income. Short-term losses offset short-term gains first. Long-term losses offset long-term gains first. After that, remaining losses of either type can offset the other type. Tax loss carryforward is powerful. If you have $50,000 in net losses in a down market year, you use $3,000 against ordinary income and carry forward $47,000. In future years, you apply that carryforward to offset capital gains, meaning you can sell appreciated investments for free as long as you have carryforward losses. Many investors build up significant carryforward banks during market corrections that provide tax-free selling for years afterward. When does tax loss harvesting make the most sense? When you've had large capital gains in your taxable accounts from selling appreciated positions. When you're rebalancing your portfolio and would otherwise trigger gains. When a market decline gives you temporary paper losses that you can realize today and replace with a similar holding. And when you anticipate high income this year and want to reduce your adjusted gross income. Watch out for these common tax loss harvesting mistakes. Failing to reinvest immediately, staying in cash for 30 days means you miss market recovery. Triggering a wash sale by buying the same fund in a different account. The rule applies across all your accounts, including a spouse's account and an IRA. Harvesting short-term losses when you should wait for long-term treatment, sometimes holding 12 months first gets you the much lower long-term rate. Your year-end tax loss harvesting checklist. In November and December, review your taxable portfolio for unrealized losses. Identify positions where harvesting makes sense. Execute the sale and immediately reinvest in a substantially similar but not identical fund. Confirm your December 31st net capital gain position. Track everything carefully. Your cost basis on the replacement investment is key for future tax planning. Tax loss harvesting converts unavoidable investment losses into real, usable tax savings. The strategy costs you nothing extra and can save you thousands per year. Start reviewing your taxable portfolio every fall. Subscribe to Everyday Wealth Guide for more tax-efficient investing strategies every week.